In Module 4, we will delve into the process of estimating costs and categorizing expenses within a business budget. Understanding and categorizing business expenses are essential steps in building an effective budget. This module provides insights into how to identify and manage various types of costs, including fixed and variable costs, cost of goods sold, COGS, operating expenses, OPEX, and capital expenditures, CAPEX. Understanding business costs. Business costs can be divided into two main categories: fixed costs and variable costs. These classifications help in budgeting and forecasting because they determine which expenses are predictable and which fluctuate with business activity. 1. Fixed costs. Fixed costs are business expenses that remain constant regardless of the level of production or sales. These costs do not change with the volume of goods or services produced and must be paid even if the business is not making a profit. Examples of fixed costs: rent, monthly payments for office or warehouse space, salaries, employee wages that are not based on performance or hours worked, insurance, monthly or annual premiums for various types of business insurance, depreciation, the loss in value of tangible assets such as machinery and equipment, licensing and fees, regulatory fees or licenses that the business must renew periodically. Fixed costs are important to track because they represent long-term obligations that the business needs to pay no matter how well it performs. A good understanding of these costs helps businesses set aside enough funds to cover them, ensuring financial stability. 2. Variable costs. Variable costs are expenses that change in direct proportion to the volume of production or sales. These costs increase as production or sales increase and decrease as production or sales slow down. Examples of variable costs: raw materials, cost for the materials needed to manufacture products; commission-based salaries, salesperson commissions tied directly to sales performance; utilities, costs that vary depending on business usage, such as electricity and water; packaging, cost of packaging products for shipping or retail sale; freight and shipping, costs related to the transportation of goods that increase with higher sales volumes. Variable costs are closely tied to a company's output. Accurate estimation of variable costs is essential for budgeting because businesses can adjust their spending based on how much they produce or sell. 3. Semi-variable costs. Semi-variable costs are a hybrid category containing both fixed and variable components. These costs have a baseline fixed component but also include a variable component that changes based on usage or output. Examples of semi-variable costs: phone and internet bills, a base fee plus additional charges for usage; salaries with overtime, a fixed salary base with the potential for variable overtime pay; maintenance costs, a fixed amount for regular maintenance plus additional costs based on usage or equipment wear. Understanding semi-variable cost is crucial for forecasting because they provide flexibility in adjusting expenses based on actual business activity. The cost of goods sold, COGS. The cost of goods sold, COGS, is a critical expense category for any business that manufactures or sells products. COGS represents the direct costs involved in producing or purchasing the goods that the company sells during a given period. 1. Key components of COGS: direct materials, the raw materials or components used in the production of goods; direct labor, wages of workers directly involved in the production process; manufacturing overhead, direct expenses incurred in the manufacturing process, such as factory utilities or machinery depreciation. 2. Calculating COGS. The formula to calculate COGS is as follows: COGS, beginning inventory, plus purchases during the period ending inventory, COGS, beginning inventory, plus purchases during the period ending inventory. This calculation helps businesses understand the direct costs of producing or acquiring the products they sell. Accurate COGS calculations are essential for determining profit margins and setting prices. 3. Importance of COGS in budgeting. COGS directly impacts gross profit, and understanding how it behaves is crucial for effective budgeting. By monitoring and managing COGS, businesses can identify areas for cost reduction, improve efficiency, and optimize pricing strategies. Operating expenses, OPEX. Operating expenses, OPEX, refer to the costs associated with running the day-to-day operations of a business that are not directly tied to production. These costs are essential for maintaining business operations but do not include the cost of producing the goods or services. 1. Types of operating expenses: administrative expenses, salaries for office staff, office supplies, and administrative overhead. Marketing and advertising, costs related to promoting the business and acquiring customers. Research and development, R&D, investment in new products or service innovations. Sales and distribution, costs associated with delivering products or services to customers, including shipping and delivery costs. 2. Importance of OPEX in budgeting. OPEX is crucial for understanding the ongoing costs required to keep the business running. Monitoring and controlling operating expenses ensures that a company doesn't overspend in areas that don't directly contribute to production. By managing OPEX effectively, businesses can increase profitability and reinvest savings into growth areas. Capital expenditures, CAPEX. Capital expenditures, CAPEX, are large, one-time investments made in long-term assets, such as property, buildings, machinery, and technology. Unlike operating expenses, CAPEX is not fully expensed in the year it is incurred, but is capitalized and depreciated over time. 1 key examples of CAPEX: property and buildings, purchasing or leasing land and office space; machinery and equipment, buying or upgrading production machinery and technology; vehicles, purchasing vehicles for business operations; computer systems and software, investing in IT infrastructure or enterprise resource planning, ERP systems. 2. Importance of CAPEX in budgeting. CAPEX plays a significant role in long-term business growth and expansion. Proper planning and budgeting for capital expenditures ensure that businesses can afford necessary investments without harming short-term liquidity. Businesses should assess whether CAPEX projects align with long-term goals and how they impact cash flow. Estimating costs and building cost categories. The process of estimating costs and categorizing them into appropriate categories is critical for creating an accurate and comprehensive budget. Here's how to approach cost estimation. 1. Identifying cost drivers. Start by identifying the key factors that influence each type of cost. For example, what drives fixed costs, e.g., rent, salaries, insurance? What drives variable costs, e.g., raw materials, commissions, shipping costs? 2. Using historical data. Utilize historical data from the business's previous financial periods to estimate future costs. This data will provide a solid foundation for estimating future fixed, variable, and semi-variable expenses. 3. Benchmarking. Use industry benchmarks to gauge whether your business's costs are in line with competitors and industry standards. This helps identify areas where the business may be overspending or where there are opportunities for cost savings. 4. Including contingencies. It's crucial to include contingency amounts in the budget to account for unforeseen expenses. A common rule of thumb is to allocate 5 to 10% of your budget for contingencies, depending on the volatility of your industry. Conclusion and summary. In Module 4, we have explored the different types of costs a business incurs, including fixed, variable, and semi-variable costs, as well as how to estimate and categorize them for accurate budgeting. We've also discussed critical categories like the cost of goods sold, COGS, operating expenses, OPEX, and capital expenditures, CAPEX. Understanding these categories and accurately estimating costs ensures that businesses can manage their finances effectively, plan for future growth, and avoid potential financial pitfalls. The next module will cover how to implement various budgeting techniques and create dynamic budgets that adapt to changing business conditions.